price, it's already set. You get a big position. But the most important reason to do a private placement is the warrant. The single most important reason to do a private placement is a warrant. The warrant is the right but not the obligation to buy more stock at a fixed price over a fixed period of time. Or, put more succinctly, the warrant gives you the ability to retroactively profit again from those rare yes answers to unanswered questions. Everybody get me with that? This is really important. If you provide the capital that answers an unanswered question, and you take a stock from $1 to, say, $5, that in and of itself is extremely pleasant. But if in addition to having the stock go from $1 to $5, you have a warrant that's exercisable at $1.50, you made $4 on the stock, you made $3.50 on the warrant. You turned a 5-bagger into a 7-bagger or an 8-bagger. If you understand that in a portfolio sense, the expectation in exploration is failure, but the money that you make on the winners is outstanding enough that it amortizes the losers, the difference between success and failure to speculators that have the ability to avail themselves of private placement really has to do with warrants. When I look at the outperformance of my own accounts, personal accounts, in the period sort of 1995 to 2010, almost all, I thought that the outperformance of my accounts had to do with, my genius or my timing. Well, wrong. Really, 85% of the outperformance had to do with warrants. There were circumstances where I had big warrant packages in companies that became very, very successful. And the rewards that I generated as a consequence of that, let's just say they amortized a lot of sin elsewhere. The other thing that I want to talk to you about with regards to private placements, and warrants helps here, are selling strategies. The first part of the selling strategy is the same, whether you buy the stock in a private placement or not. If you understand that whether you know it or not, you are speculating in the answers to unanswered questions. When you appear to get a no answer, or you are certain to get a no answer, the reason that you own the stock is gone. When the reason to own a stock is gone, the stock must be gone. This is the biggest fight I have with investors. Investors will transfer in a laundry list of stocks to me. 30 stocks, 40 stocks, 50 stocks is common. And we review them. Let's start at the top. Amalgamated Aardvark. That's got a lot of A's in it, right? And the speculator says, so Rick, what do you think about Amalgamated Aardvark? And I sort of say, well, until right now I was blissfully unaware of the existence of Amalgamated Aardvark. What do you think about it? Oh, well, it's terrible. Well, why don't you sell it? Well, I can't sell it. Why can't you sell it? I bought it for $4 and it's at 50 cents. And if I sell it, I'll lose $3.50. I have to say, no, you've already lost $3.50. The question is, what are you going to do with the last 2 quarters? You get it? When the reason to own a stock goes away, the stock must go away. People say, well, I'm going to wait till it goes back to what I paid for it. Well, why would it do that? If the answer to the unanswered question, if the circumstance that creates value goes away, why would it go back? Accept your loss, drive on. Losing 30% is a drag, but it beats the hell out of losing 75, and that's where you're headed if you don't take the 30. In a good market, like the one that we're moving into, there's a different circumstance that's equally pernicious. If the stock goes from $1 to $2, but nothing has changed in the company, arithmetically, the company is half as attractive. A company that had a $20 million market cap that goes to $40 million with nothing happening in the company is precisely half as attractive arithmetically. So in my particular case, if I buy a private placement and the price expectation that I have in place, I achieve before the unanswered question is answered. In other words, where the anticipation of the yes answer is strong enough that I get the reward that I had anticipated, I always sell enough stock that I get the placement for free. You follow that? I'll help you remember it. This is called the point of no concern. That's when you have all your scratch back. That's different than the point of no return, which is where you lose your money. So a circumstance where a stock achieves your expectation without the question being answered is the most wonderful of all circumstances. Get your cash out of harm's way. Similarly, as I say, when the reason to own a stock goes away, the stock must go away. I like to exercise my warrants with proceeds from sales. I don't like to double down in circumstances unless the exploration information that I have is so good that I'm prepared to buy stock out of the market too. Everybody understand that? If you're playing the game, if you're a trader, don't double down by exercising warrants. Use the proceeds of sales to exercise the warrants and keep your own risk under control. Now, an interesting thing happens when you do a private placement. You get a yes answer and your price expectation isn't met.